those concepts that you might need to always remember whenever you meet the same, questions or the concepts being set. Now, members, all of us, I believe you've been able to get the file I shared in the WhatsApp group. I hope you have it. So let's read it together and see what the examiner is trying to ask. Because, like I said, and I still repeat the same, you do not have to revise 100 questions. All you need to do is to scout for questions. You can go through 10 questions and realize the concepts that have been shared there, that have been set, are almost the same. Maybe there are only 5 concepts being set. Yes? So once you have the concepts, you don't have to revise all the 100 and get the answers. No, it's not about cramming or mastering the answer. That is not important at all. What is important is once you've understood how to go about it, you don't care about how the question is brought. All you care about is, do I remember the concept? Now, I want us to go through this together, members, and get to see what the examiner is testing and the approach you are required to adopt in an exam setting. I hope we are together, and I hope everyone has the question opened in front of them. All right, so I will go ahead and read. The question is from August 2024. I've shared the questions now. This is question number 21, and it says, Mzalendo Limited is a listed company. The following financial statements relate to the company for the year ended 31st of December 2023. All right, statement of profit or loss for the year is given there, and I hope all of us can be able to see it. We have sales, we have the cost of sales, gross profit, and interest income. We have expenses have been given there. Yes, and I hope you can see the usual elements of expenses that I told you will always find their way in any of these questions. Things like finance cost and these categories of expenses, you will always meet them in the questions that you will be able to meet. And you have the income tax expense will always be there. And profit after tax, dividends being paid. So whenever you look at the statement of profit or loss, this one has already been prepared. And because we are just coming from preparation of these published accounts, at the back of your mind, I hope you still remember the treatment of dividends paid. And I asked you, if you are preparing published accounts and there are differences, somebody gives you in the trial balance just the word dividends without the word paid. Remember the treatment, we discussed it. And where someone gives you in the trial balance dividends paid, how to handle that and the differences in the two. The same way finance cost, in the trial balance you can be given finance cost paid. Again, someone can just say finance cost. I hope you remember the differences I explained and we discussed together. Now, this is the statement of profit or loss. Then the statement of financial position is given here. And in most cases, when handling questions on cash flow statements, you realize examiners will give you comparative statements for the previous financial year and for the current financial year. They will always bring it in this pattern because you are supposed to follow the flow. You are supposed to check on comparative analysis on the movement of PPE elements and movement, let me just talk about assets and the liabilities in that case. And again, the equity elements to see if there was a change because we are tracing movement of money. If you bring on board more shareholders or more owners, they must have subscribed and brought in money. So you will be able to trace the movements in each of those line items. All right, so I will not read line by line items because these are elements we already know. I will just want you to check on something here. There is this thing that was brought here, which is of interest. I want you to look at the non-current assets and you realize, apart from the PPE, which we are all used to and we are aware of, you will see they also brought something like financial assets at fair value through OCI, and it is categorized under non-current assets. That is one of the things we have to be very, very much aware of and keen on to see how we are going to handle it. I want you also to see the intangible assets. Of course, intangible assets are things we know. So intangible assets are also given there, and they've been categorized under non-current assets. Look at the current assets categories. These are the usual items: inventories, receivables, interest receivable. That's okay. Cash in hand. So nothing new here, nothing strange. Let's come to equity. Nothing strange again, because we have the ordinary share capital, we have share premium, revaluation reserve, and retail profits. So those are just the usual elements. We are just going to look at the movements and the changes that happened. Then we have non-current liabilities. I want you to look at non-current liabilities. This is just a loan item, which is okay. Then look at this. There is a non-current liability called obligations under finance lease. Obligations under finance lease. So this is somehow a new element which we must be keen to check on and see how it will affect our cash flow statement. Current liabilities also, bank overdraft. This is a cash flow statement. We are going to see the impact of a bank overdraft. Then look at also obligations under finance lease, also falls under current liabilities. So we have one under non-current liabilities, and we have the same item now again under current. So non-current and current, they both have obligations under finance lease. What could be the difference? That is one thing we need to ask ourselves. And as we ask ourselves those ones, I want us to look at the additional informations. Those are the adjustments that happened during the year. So that is all the information required in the two statements given. So in the additional informations, I only see there are 3, so nothing much here. So let's read and see what happened and how we are going to start. And we are going to employ the same mode or the same approach that I had given you the other time when preparing published accounts or financial statements, where you get into an exam room, you read a question, and you come and see the required is statement of cash flows from Zalendo Limited for the year ended 31st December 23 in accordance with IAS 7. Now, because this is something, once you read the question and you already have the idea, you don't waste time. Go to the side of the question and divide the page into 2. Once you divide the page into 2, your intention is to start doing your posting straight away so that you maximize on the entries and you maximize on the scores that you're supposed to get from this question. So the same approach is what we're going to use. We will be doing adjustments, but there are those entries that will not require any adjustments, meaning we will be posting them straight away. So for now, I want us to just read these 3 additional informations, then we can start. All right, so I hope we are together, members. I hope we are together. Just confirm, maybe 1 or 2 people to just confirm to me that we are all okay, that we are moving together. All right, very good. So I will read the additional informations. The first one says, during the year, the company issued 10 million, in bracket, 2 shillings per value. Very good. Now, members, you see the way the examiner starts giving you this additional information. I remember explaining very well elements affecting ordinary share capital. One of it was the issue of shares. So this additional information is the issue of shares. And I remember telling you the other one, in the trial balance given, they might give you the par value in bracket, or in some instances, they will not give you the par value. But in this case, I hope you are now seeing the difference. And whenever you see a par value given in bracket, whenever you see par value given besides the amount of ordinary shares, you need to ask yourself if there will be any premium on issue or not. Even if it is a conversion, even if it is a transfer, you need to be very careful. Now let's continue reading and see. The company issued 10 million and the par value is 2 ordinary shares at a price which was 100% above their par value. The price of issue was 100% above their par value. So we need to ask ourselves, at what price were these shares sold, or at what price were these shares issued? Because it is 100% above par value. We already have the par value. So somebody should already compute 100% above the par value will be at what rate? What would be the selling price of the shares? All right, I'm seeing some chart here. Okay, Winnie is telling us 4 shillings. Yes, and Grace also the same 4 shillings. Very good. All right. Then they incurred issue cost of 2 million. You can see that section, incurring issue cost of how much? 2 million. Good. Eileen is also saying the selling price is 4 shillings. All right. I see you all share into the same idea. We are going to see additional information number 2. During the year, some items of PPE were bought under a finance lease, right? Amounting to 56 million. Now you see what the examiner is trying to do. If you look at the statement of financial position, we pointed out that we have some elements that are not very usual. And you can see under non-current liabilities, obligations under finance lease. Again, under current, we have the same obligations. And again, additional information number 2 is being tied to those leases, the finance lease, which have been given there. So they bought some elements of PPE under finance lease, and the amount is 56 million. And then disposal of assets having a net book value of 38 million, realized 42 million. This is a very interesting concept, members. I hope you still remember. We followed and checked on the movement schedule, PPE movement schedule, and we looked at keenly elements affecting PPE account. I hope you still remember how to compute gain or loss on disposal of PPE. Again, we have it here. We're going to repeat the same concept, and I believe after we are done with this, your understanding of that concept will be very, very good, and you will use it in the future. Again, depreciation charge is given as 74. We are doing cash flow statement. That's why they already give you the depreciation. But should you get an examiner who wants you to compute the depreciation charge for the year when preparing these published accounts, which you already did, I believe you still remember the formulas and how to compute the depreciation charge for the year. In this case, you must be given because the income statement was already prepared. Though depreciation is not a line item under expenses, but it falls under one of these categories of expenses. You remember what we did when preparing that. So I just want you to remember that concept. All right. Then number 3, interest on finance leases of 6 million was included in the interest payable charged to the statement of profit or loss. Members, get that statement. Interest on finance leases of 6 million. You see, there is finance lease, which was in note 2, where they bought more PPE elements, and the amount was 56 million. So interest on that lease, because this is a mode of financing. Leases is a mode of financing. So the interest or the cost that they paid on that lease, part of it was included, and the amount of 6 million was included in the interest payable charged to the statement of profit or loss. So when we talk about interest payable, that falls under the finance cost. Part of it is here under finance cost. And if you look at the current liabilities, you will see we have interest payable, meaning there is some outstanding liability on the same line. And we have obligations under finance lease also under current liabilities. So let's now see, how do we put this thing into a format that we are going to see how to get your marks in an exam, statement of cash flows. Now, let's go ahead and prepare the format. Like I told you, that is the approach that is desired of you to harvest the low-hanging fruits as much as possible. So very first, I hope you remember the format, and I will just start by writing the name of the company. The company in question is called Mzalendo Limited. So what do? We just write Mzalendo. Let me put it in capital. Mzalendo Limited. And this Mzalendo Limited, we are preparing their cash flow statement. So we just write statement. What did I just type? Statement of cash flows. Statement of cash flows for the year ended. What was the year ending? Let me just check the required. 31st December 2023 for the year ended. 31st December 2023. All right, 31st December 2023, like that. Now, good. I've just written the name of the company and what we are supposed to prepare. Then after that, look at the level of precision. Our figures are given in millions. Yes. So it is normally prudent to make sure you don't forget about that very simple concept. That precision is very important. Our figures are all in millions. So I will just type, it is in shillings, millions, like that. And when preparing the statement of cash flows, normally, I remember telling you in published accounts, you can opt to use one column. The only thing you be sure to do is to make sure you differentiate between income elements and expenses, where you bring your expenses as in a bracket or in negative or using parentheses so that someone can easily see this is an expense, this is an income. That is, if you want to use one column. You can use two columns where you have the debit and the credits. I believe you remember that part when we were discussing. So in cash flow statements, it is prudent you use two columns. But again, no one will penalize you if you use one column. Using two columns just makes your work easy to work on the totals under each category of cash flows. So today, I just want to adopt the two columns approach because our work should look neat and it will help us to follow up on the totals for each category of cash flows. So usually, I believe all of us know, we start with cash flows from operating activities. That is the first category of cash flow elements that we are going to deal with, cash flows from operating activities. Then, after we've handled all the elements under cash flows from operating activities, I just want to interfere with the alignment of these elements here to just make sure we don't have a lot of blank spaces in between like that. All right. That's what I want. I want it to appear like that is okay. Good. Then after cash flow from operating activities, we know we have cash flows from investing activities. Cash flows from investing activities. What I'm doing is just drawing the format, and this format, I believe all of you know about it. And I know someone is already asking at the back of your mind, what is the difference between the direct approach on preparing cash flow statements and the indirect approach? Yes, members, you have to remind yourself and know what brings the difference. At what point do you have the difference between those two? Yes, so start thinking in that line, and we will be touching on some areas of differences between those two approaches. And we will see in IAS 7, which approach is mostly desired or commonly used and why. All right, so after cash flows from investing activities, we normally have the third category and we call it cash flows from financing activities. Those are the three major categories of cash flows that we normally deal with in these statements. And Once you've known the three categories, because this is the format that you'll have to follow according to IAS 7, one thing you ask yourself, what elements am I going to use under operating activities? And what are operating activities? Then, what elements am I going to include under investing activities? And what are those investing activities? Again, the same question when you talk about financing. And as we start doing this, I want somebody to remind us. I want you to look at this element of finance cost. There are two ways in which you can treat finance cost in this statement of cash flows. And I want somebody to just remind us. We're just touching on elements, members. Yes, I know somebody might be waiting for answers for this question. But like I normally say, the most important thing is not getting the answer, because no one will bring you this question the way it is. You will not meet this question in the December exam you're supposed to do. What you'll meet, you will get these concepts that were being tested in this question. So it is not about getting the exact answers for this question. It's about knowing how to handle a question that will test the concepts similar to the ones that have already been tested. I hope, members, you are getting it. So I want you to just start thinking. Finance cost, there are two ways in which you can classify and categorize finance cost in this statement of cash flows. And they are both allowed. They are both allowed. I already gave you one question to get the difference between direct method and indirect method of cash flow statement. I'm now shooting another one. Finance cost treatment. When do you treat finance cost where and why, and what is the difference in the two? And will the overall effect be the same? So start thinking about that. We are going to touch on it, but somebody feel free to let us know if you want to unmute and speak, or you can make use of the chat box. Tell us your idea or what you think about treatment of finance cost and the various ways in which that can be done. All right. Now, again, what elements do we have under cash flows from operating activities? Somebody just remind us. There is an acronym which I believe all of you know. An acronym to help you remember those elements. Somebody just remind us in the chat box very fast. Cash flows from operating activities. What acronym do you normally use? Aha, Alex is saying dial GF, then RIP, right? Very good, thank you, Alex. Is someone having a different way to express that acronym, or you all share into the same? Dorothy is giving the same. Elo is giving with some spacing, dial GF or RIP. Then Elo is adding TI. Elo is adding TI, which the other two members did not include. So Elo, if you don't mind, tell us the two initials of TI. I'm picking on them because they're different from what the other members gave. So what is the TI standing for? What is the TI about? Elo. Elo, tell us. I want us to start doing our postings straight away. Very good. Thank you, Elo. Thank you. HP. Thank you, HP. Tax paid. Tax paid. Tax paid. And I believe the other I should also go for the interest what? Interest paid. Very good. Members. Very good. Thank you, HP. Thank you, Eileen. That's right. Good. Now, with those acronym, you can sometimes call it dial God's number for food, or you'll decide to rest in peace. Dial God's number for food, or you rest in peace. Right. So I want us to start using that acronym to get the elements that we need here. Now, that D in dial, that D stands for what? That D in dial stands for what? Give me now the names of the elements. The names of the elements in the acronym. All right, depreciation, very good. Depreciation, very good. Depreciation. I'm leaving some space before I start typing depreciation, and I hope you know why. I hope you know why. Depreciation. The I, what does the I mean? The I, dial God's number for food, or you rest in peace. Depreciation, then we go to impairment. Very good. Impairment. Very good. Dial. What of the A? What of the A in the acronym? Amortization. Very good. Thank you, HP. Amortization. And as we give the names, these elements of using this acronym, do we also know the differences of this, of these terms? Let us not just master. Do we know the difference between depreciation and amortization? And do we know the difference again with, impairment? These three elements, they share into, the impact that they have on the elements that are applicable to them. But do we know the distinctive differences between depreciation? When do we talk about depreciation? When do we talk about impairment? And what elements does it affect? And when do we talk about amortization? And what does it affect? Please make sure you also think about that line. Okay, after amortization, what do we go to? That is under dial. We need the L, loss on disposal. Thank you, thank you. Loss on disposal, very good. Okay, that is dial. God's number, the G. The G, what does the G stand for? Gain on disposal of PPE. Very good, thank you, Alex. Gain on disposal of PPE, that is very good. Dial God's number for food. What is the next element? What is the next element using the acronym? We are in the G. We are in the G. Now we come to F. 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 What does it stand for? Right, finance cost. Thank you, Grace. Thank you, the other members. iPhone is there, Alex, CPA. Okay, so finance cost. And I remember asking you about the treatment of finance cost. I know it is in this acronym and adjustments of operating activities, but there is another way which is allowed, how to also handle finance cost without you putting it under this category. And no one has even talked about that, members. Putting it under operating activities is not cast on stone. You can also opt to use it elsewhere and avoid using it under operating. That's what I wanted somebody to tell us. People are still quiet, all right? Elo is saying something for financial institutions, they should put it under operating activities, all right? What of the other? Okay, so after finance cost, what else? Dial God's number for food, or you rest in peace. The other, we have receivables. Thank you, Grace. Thank you, Grace. Receivables, that are the working capital elements. After receivables, there is an I and then there is a P. Rest in peace. Rest in peace. Inventory. Thank you, Steve and Grace. Inventory. Very good. The other one, what is the other acronym standing for? Thank you. Thank you. That is payables. Very good. Payables. Very good. Very good. Then we bring the last two. We bring the last two notorious fellows, which will always be following you wherever you go. Which other two fellows are we bringing on board? There are those other two fellows. That closes that section. Tax paid. Thank you, CPA. The next one is what? We have tax paid and interest. Thank you. Thank you, LJ. Thank you, LJ. So we come and talk about tax paid and interest paid. Good. Members, these are the elements that we are looking out for to handle under operating activities. So before we go to the elements required under investing, Of course, we can list them. Let's just go ahead and, have all of them, because I want us to start doing postings for those that do not require adjustments. Because the aim in an exam room is to get to harvest the maximum possible score. And for you to harvest the maximum possible score, remember, you are competing against time, and at the same time, you're trying to maximize on your score. Time is running, you need marks. So in that case, you have to draw the format in full, then you start doing your posting. If you get an adjustment you don't understand, just post whatever you can get. And once you are stuck, leave it there. Move to the next item or to the next question so that you harvest whatever possible. Now, under investing activities, what elements do we put under investing activities? What elements do you put under investing activities? Very fast. What elements do you put under investing activities? Of course, there are those few elements we are going to still go through in this format, just to remind ourselves, because I've been shooting questions as we go, and I just want you to trigger your mind so that you make sure you're at par with all of them. All right. I'm seeing sale or acquisition of an non-current assets, acquisition of PPE. Okay, right. Purchase of PPE. Thank you, members. So when you talk about purchase or acquisition, they mean the same thing. You purchase or you acquire PPE elements. So I will just write there, purchase stroke acquisition of PPE. That's right. The next element that falls under that category of investing activities. Purchase of assets. That's okay. Disposal, stock proceeds. Stock proceeds of PPE. So we talk about proceeds on disposal. Proceeds on disposal of PPE. All right. If you dispose your PPE and you get whatever you realize is falling under investing activities. Something else? Investment income. Thank you, Grace. Investment income. Thank you, Grace. Somebody else. Let me see. Thank you, Grace and Val. Any other element under investing activities? We are reminding ourselves, members, you will always need those elements. All of them might not be in our question here, but you will need to know all of them so that whenever you get a question, you will be able to be comfortable knowing which element falls under which category. Is that all under investing activities? That all? Dividend received. Thank you, Eliud. Dividend received. Thank you, Eliud. Dividend received. Thank you, Eliud. Acquisition of intangible assets. Acquisition of intangible assets. Thank you, Grace. Acquisition of intangible assets. The same way you acquire PPE, you can also acquire intangible. Purchase or acquisition of intangible assets, that falls under that category. That's right. Somebody said something here which I'm forgetting. Dividend received. Okay, because you earn dividends from an investment. You invested in shares of a certain company. You invested. So when you earn dividends, that is an investment income. All right. So we can either put it under investment income or just as dividends. It's okay. Okay. Purchase of subsidiary. Yes. Purchase or acquisition of subsidiary. Purchase or acquisition of subsidiary. All right. So we can leave that list at that point. If there is any other element that we will get, we will still put it under that category. Because again, remember, when we talk about investing activities, you talk about, as much as we talk about investment income comes in various forms. Dividend is one form of the investment income. Sometimes you can also call it interest received or interest income will still fall under investment income. So there will always be those various categories, but they fall under the same. All right. Let's come to financing, members. Let's just pick on the common elements. The common elements. that fall under these categories. As we look at any other of those special ones to put. All right, financing activities. Somebody remind us very fast. I want us to try move with a little speed. Cash received from the issue of ordinary shares. Okay. Okay, so I will just write issue of shares because the purpose of issuing shares is for you to raise capital. And whenever you issue the shares, you expect to receive the capital. So that is, the proceeds on issue. All right, thank you there. Dorothy, issue of shares, thank you. Mawia is telling us dividends paid. Thank you, that's right. Dividends paid because those shareholders, you have to pay them their returns. You have to pay them their dividends. That falls under financing activities, right? Issue of shares, thank you. That's already taken care of. Dividends paid, okay. Loan acquisition. Loan acquisition. If you acquire a loan as a mode of financing or a method of financing, that is under financing activities. Loan acquisition. All right, thank you. I'm looking at the chat box here. Aha, Eliud Juma is telling us something interesting. Share premium. Eliud Juma is telling us something very, very interesting. Very, very interesting. Share premium. And I would challenge you and ask you, yes, share premium is very correct. And share premium is only arising on issue of shares. Premium on issue arises on issue of shares. So, Eliud Juma, you are correct, but I hope you'll allow me not to write this share premium as a line item on its own. Let's treat it under issue of shares. I hope, Eliud Juma, you'll be okay with that. I hope you'll be okay with that, all right? Loan, okay. Loan, I think I've already mentioned something to do with the loan, which is okay. Dividends paid, I've also done that. Interest paid, acquisition of principal loan. All right, all right. Loan acquisition, interest paid. Now, you'll see when I asked you about finance cost here, this finance cost can also be categorized under financing activities. IAS 7 allows you to treat finance cost either under operating activities, or you can as well treat it under financing activities. If you want to talk about the interest paid, you see this part, the interest paid. So the interest that you pay, you can as well avoid using it up here and bring it under financing activities. I'm seeing there is a member who has told us about interest paid. Now, that is what I was asking you about. It can still fall under this category. But because we opted to use it above, we cannot again repeat the same. So you decide on where you want to use interest paid and you will still be good. Dividends paid to NCI, all right, thank you. When you pay dividends to ordinary, you also pay dividends to, NCI, so that's right. Dividends paid to the non-controlling interest or minority shareholders, that's right. Loan repayment, that's very correct. Loan repayment is correct. Loan repayment, that is correct. Is there something else I'm leaving out? Okay, Mawia is having some question here. I have a question. Why do we classify dividends received as cash flow from investing, yet dividends paid as financing? Thank you, Mawia. This is an interesting one, and let me just, try to put it into words that I hope you'll understand. Okay, now, when we classify dividends received for us investing, cash flow from investing, it simply means when do you receive? When do you receive? Remember, we are talking about an investment. As an investor, I know some of you here, you're running maybe some businesses, or you've invested in shares, either shares of a circle or shares of a company. Yes. Now, when you invest, that is part of your investment portfolio. If you have a range of investments, what do you expect? What do you expect from this investment in shares? If you invested in shares, you expect to receive dividends from that circle. Like now we are edging towards the end of the year. Most SACCOs have started dividend discounting. Most SACCOs are already paying dividends. They're allowing you to discount and all that. Now, this dividend that you receive, it is from your investments. That's why we classify dividends received under cash flow from investing activities, because you receive dividends because you invested in shares. Then, when we come to financing activities, remember, we are looking at sources of finance. You did FM and AFM. We know the sources of finance. One of it is shares. When you talk about the ordinary share capital or ordinary share capital, when do companies issue shares? They issue shares so that they raise capital, they raise finances. It's because it is one of the ways to raise finances. Now, this is the owner's equity. When you issue shares and bidders come and apply and they are given a go-ahead to buy the shares or to purchase the shares, given the conditions maybe that existed at that point, they will pay. And this payment that they normally do, I hope you remember the word call options, or maybe the call. Let me talk about call. There will be the first call, the second call, and things like that, where they'll be required to redeem the shares they purchased. If you buy shares of a company, you'll be given calls. You'll be told these shares you're buying, it falls under, for example, let's say 3 calls, or you can pay them in 2 calls. So in the first call, maybe you are required to pay 50% of the share capital of the shares that you bought. You can opt to pay them at once, given the conditions existing in that company, or you can pay them in bits, either 2 or 3. Those ones are called the calls now. So when you pay the money because you bought shares, that money that you pay, these people, now you become a shareholder, you become an owner of that company, an owner. And as an owner, meaning you've invested in that company, you expect to be paid dividends. Now, when you talk about financing activities, talk about in the position of the company now. As the company, you've issued shares, you received the money from the people who bought the shares, from the investors. Now, these are your shareholders. Once they become your shareholders, they will require return on investments. To them, they invested. To you, they brought you the finances. Now, to you as the company, when they brought you the finances, these are now your shareholders. As your shareholders, from your operating profits, the profits that you get after taking care of all the expenses, you have to pay them, you have to share them out with them. They are the owners of this company. Now you pay them dividends. That's why when you pay them dividends, this is normally categorized under financing activities. Payment, dividends paid, dividends paid. They brought finances. They became shareholders or the owners. Now they have to share into the profits that you make from your business. Now that profit that they share is the dividends you pay to them. So when you pay them dividends, that's why it is categorized under financing activities. Dividends paid. Dividends paid. I just hope that the member who asked has gotten something. Mawia, you'll confirm if you've gotten something out of that as we continue. Now, I want us to stop the financing activities at that point. If there is any element that will come, we are free to still add it there. Good, thank you. All right, now, members, I want us to straight away start by asking ourselves the difference between direct approach and indirect approach. I asked this question and no one has responded. Now, as I wait, give somebody a chance to respond, I want you to check on that, and we come to the last part of this format. And the last part of the format of cash flow statement, there is always these elements where we are told there is increase or decrease, or maybe let's talk about net changes in cash and cash equivalent, net changes in cash and cash equivalents. So we talk about net changes in cash and cash equivalents. And when we talk about these net changes in cash and cash equivalents, we are going to look at the overall effect of cash flow from operating, cash flow from investing, and also from financing. We get the net effect or the net changes. Now, someone will ask you, what are these cash and cash equivalents? Somebody just remind us as we start doing the postings. Just in 1 second, if someone doesn't respond, I will give you an explanation. I just don't want us to, I don't want to, block somebody who'd want to contribute numbers. Cash and cash equivalents. What does that word stand for? What do they mean? Cash and cash equivalents. All right, Victor Muli, cash at bank, bank overdraft. Thank you. HP, cash in hand and overdraft. Thank you. Elo is giving us short-term investments, cash and overdrafts. All right, all right, all right. Those are very good contributions and they're all correct. Now, cash equivalents are held for purpose of meeting short-term cash commitments. And these cash equivalents, they are not meant for investments or other purposes. They're only meant to meet short-term cash commitments. When we use that word meant for short-term commitments, now we know. Now you see, like Eliud Juma is telling us short-term securities. You can also tell this is just a short-term commitment. When you talk about cash, cash is in liquid form. When you talk about overdrafts are short-term commitments where you just wanted to sort out some short-term obligation, but the money in your bank was not enough. So you went for an overdraft. All those fall under cash and cash equivalent. Yes. So for an investment to qualify as a cash equivalent, it must be readily convertible to a known amount of cash. And this will always be, subject to some significant, risk of changes in the value of that investment. So whenever you want to classify an investment or to treat an investment as a cash and cash equivalent, it must have a short-term maturity. Like now you see, there is this member who talked about short-term security. So this investment must have a short-term maturity. And short-term maturity, let's say, for example, 3 months or less from the date of that acquisition of that investment. So this investment will qualify to be categorized under cash and cash equivalent. I hope that makes sense to us members. Now, let's start from operating activities. Let's start from operating activities and see where do we normally start. I'm not going to the deeper explanation of the difference between direct approach and indirect approach because I've asked this question. No one has responded. I will explain eventually, but I'm not doing it now. I want us to start doing the postings. And to start doing the posting in our approach, we are starting with profit before tax. Profit before tax. What instance, if you are given profit after tax, how do you normally start? If you are given profit after tax, how do you normally start? What difference? Members, assume you are given profit after tax. You are not given profit before tax. And you have to use this indirect approach which we are used to. Where do you start from? How do you treat it? If you're given profit after. This one is before. What if you have a situation where you have profit after? What will change? What will change? Somebody? Remove tax. Okay. To make it profit before tax. Okay. Thank you, iPhone and Winnie and Val. That's what I was looking for. So for LJ, do not just go ahead and remove the tax from the profit after tax and you say they are profit before tax. In other words, you may be correct, but if you get a strict examiner who wants to see that your profit after tax where you're starting from and seeing the adjustment onto it, might deny you the marks. I'm just saying might, but yes, you are still correct. The most appropriate way, you add back the tax. Thank you. You add back the what? The tax. Now you see under adjustments, you will add back the tax. Under adjustments, make sure you add back the tax. That is the catch. And I hope you get that point. Now, let's start from this our case. We have profit before tax. I just want us to start doing the postings. These ones do not require any adjustment. And these are the low-hanging fruits. Profit before tax. Let us all go to the statement of profit or loss and look at profit before tax. And where do we get profit before tax? You see, profit before tax, in fact, it was just given there expressly. These are free mark. Just go and post it there. Free marks. You see, this is why passing AFR is easy. Even if you don't understand the additional informations, just do the posting of those elements. With that, do not require adjustments. All right. Now, let us come to the adjustments. These are the adjustments. And in the adjustments here, let us start from the ones that we can directly pick from the income statement that do not require adjustment. Now, like here, depreciation. Were we given depreciation? Were we given depreciation? Of course, this is a published account. They cannot put depreciation as a line expense, but in the additional information, did they give us depreciation? The answer is yes. I can see depreciation in note 2. I hope members you can see it. We are not supposed to compute it. It was already given. Depreciation charge was 74 million. I hope we are all seeing that. So that depreciation charge, what we do with it, we just come directly and adjust. Now, how do we adjust? What method do we use to reason out adjustments? Now, listen, members, listen. We are following on the movement of money. We are asking ourselves, how much came in and how much moved out? And eventually, what is the balance of money that we have? Now, when you talk about adjustments of this operating cash flow from operating activities, we are looking at the income statement and asking ourselves, what are those expenses that were charged? Expenses that were charged in the income statement that did not involve flow of money or movement of money. Money was not spent. Remember, these categories of expenses have various elements of expenses. And that's why additional information is there to help us understand what are those elements of expenses that were categorized under these ones here, that were charged in the income statement. We've already pointed out one of them, which is depreciation. And you see, that's why this additional information number 2 was given. That's one of the reasons, because depreciation was given here. Now, is there anyone who has ever paid for depreciation? I hope there is none. Depreciation do not involve payment of money. This is just a reduction in value of an asset with the existing policies of the company or the standard policies. So this depreciation do not involve any payment. You do not go and pay any money to the bank to pay for depreciation. So when we follow up movement of money, and remember, why are we adjusting? I want us to look at the income statement and you'll realize that we've picked on profit before tax. You see this? This is the figure that we've picked. And because we have picked this, we are trying to check and correct this, our profit. We are correcting it by removing those elements that affected it and did not involve movement of money. Remember, that depreciation that we have been given in note 2 must have been categorized under one of these categories here. It is either under admin, which is probably where it is, under admin, or if their policy was to categorize it under distribution or cost of sale, it's okay, but it must be in one of these expenses. So it must have reduced our profit before we came to arrive at the profit before tax. It must have reduced our sales. So it was sales minus all these expenses, and depreciation is one of them. So the adjustment we are doing is to add back that depreciation. It was charged as an expense, but no money was spent. It reduced our income, but we did not pay anything. So meaning our money is still intact. So we are correcting our profit. And as we correct our profit, we are adding back that expense that was charged, but we did not pay for it. Members, I hope we are getting that. We are adding back expenses that were charged, but we did not pay for them. One of them is depreciation, and we are adding back 74 million, and it was given in note 2. We have not computed it. It was given here. That's what I've done, adding it back. All right. The next element that will not require adjustment. Let me see. There is impairment. Did we have any element of impairment? Did we have any element of impairment? We've read the additional informations, and I don't remember reading anything to do with the impairment, but I remember asking you to know the difference between depreciation, impairment, and amortization, and where they apply. That understanding the difference between these three is important. I just don't want to go to that direction because will not be able to finish this question if I go that route. So just think about it, do research as we do our postings. All right, there is no element of impairment. Let's come to amortization. Amortization. Now, amortization normally affects intangibles, intangible investments. So, was there any element of amortization? Was there any element of amortization? Was there any statement of amortization expressly in our additional informations? HP is saying yes. All right. All right. And is saying -2. All right. HP is giving us there. Amortization is 8. 8 minus 2. Very good. Thank you. Thank you. I know someone is asking, where is 8 minus 2? It is very expressly given there. Where is 8 minus 6? Sorry, 8 minus 6. I want us to look at the non-current assets, members. Non-current assets, and we are looking at the movement of the intangible assets. You will realize that the intangible assets in the year 2022, the value was 8, but it reduced in value to 6 in the year 2023. Meaning what? The value reduced from 8 to 6. Now, reduction in value of intangible assets. Reduction in value of intangible assets is what we call amortization. Depreciation is reduction in value of tangible or PPE elements. So that's where the good member there got the 2. And I don't know why he said -2. I don't like the word -2, though I hope what you mean is an outflow. But because we are doing adjustments, putting this -2 here might confuse you. Yes, iPhone is saying in the balance sheet, the intangible assets reduced its value. Thank you, iPhone, that's very correct. So let's do that adjustment. Now, that amortization that we were given there, the amortization was already charged in the income statement as an expense. The same way depreciation was charged, that amortization was also charged. So what do? Did we pay for any amortization? The answer is no. This was a reduction in value out of valuation. We were not paying anything. So it was an expense. It reduced our profit. We are now correcting that profit. What do? We are now adding it back. I want to put an equal sign and do reference. I want to refer so that someone, when you look at this thing later, you will be able to understand. It is 8, which is the value of intangible assets in 2022. We deduct 6, which is the value of the intangible assets in 2023. And that's where 2 is coming from. And it is coming here as positive. We are adding it back. I hope that makes sense. We go to the next element. All right. Loss on disposal. Loss on disposal. Loss on disposal. How do we know whether there is a loss or gain on disposal? Loss on disposal. I read some disposal in note number 2. And I want us to look at that. Was there a loss or gain on disposal? Note number, was it note 2 or something? Let me see. Note 1 was about issue of shares. Let's look at note 2. During the year, some items of PPE were bought under a finance lease amounting to 56. Disposal of assets having a net book value. Disposal of assets having a net book value. Net book value was how much? Net book value of, let me look at the value, 38 million. Net book value was 38 million. And realized 42 million. So proceeds on disposal was how much? Proceeds on disposal. I'm looking at the proceeds, 42 million. So now, if the net book value was 38 and you've sold it at 42, have you made a profit or you've made a loss? The value was 38. You sold it at 42. Have you sold at a loss or you've sold at a gain? Somebody. Yes, it is a gain. You sold at a profit. Thank you, members. You sold at a profit because you sold at a value which is higher than the book value of that asset. And it is a gain of how much? It's a gain of 42, which you've realized. Compare it with the value. and we realize there is a gain of 4 shillings. There was a profit on disposal or a gain on disposal of 4 shillings. I just hope, let me not call it 4 shillings, it is 4 million. All our figures are in millions. Yeah, thank you. I see we are on the same page with members. So allow me to just delete this. After understanding it, we come to our cash flow and look at that. Now, it is not loss. So under loss on disposal, I'm not recording anything. It is now a gain. But if it was a loss, make sure you also do the adjustment here if it was a loss. But because ours is a gain, we are going to record it here. And it's a gain of how much? It's a gain of, we realized 42, but the value was 38. So it is equal to 42 minus 38. And it is 4. Now, there is something. I want to do the reverse. The value was 38, but we realized 42. The value was 38, we realized 42. And I've done that intentionally. Now, the reason why I'm putting it here as a negative is this. Remember, we are correcting our profits. We go to our income statement and realize we picked on profit before tax. Now, we are correcting this profit before tax with any adjustment that happened above it. You see this? Between profit before tax until we go back to our sales, this is the correction of profit that we are doing. All the expenses that were charged, that were deducted from our sales, but did not require any payment, or there was no payment done, we are adding them back. Then any element of income that was recognized, remember, income statement is prepared on accrual basis. Yes, income is recognized when it is earned, but not when money is received. That is the accrual basis. Yes, expenses are recognized when they are incurred. Expenses are recognized when they're incurred, but not when money is paid. Accrual basis. Now, these incomes that have been recognized does not mean we've received the monies. Now, if you look at this, our case here, there was this gain on disposal. Remember, we've received 42 million. That is the money we've received. But we are saying that it's a gain on disposal. That gain on disposal, we did not receive any money on that gain on disposal. What we received was 42 million. That gain of disposal is just a bookkeeping entry. Under accrual basis, it was recognized as an income. Remember, when preparing statement of comprehensive income or statement of profit or loss and other comprehensive income, that there is these elements of revaluation gain, and now these elements of now gain on disposal and things like that do not mean that you've already received the money. It is just a bookkeeping entry. We are recognizing them on accrual basis. So this gain, this money does not mean we received it, but it was already taken care of here. It was already taken care of. When it is taken care of, it will increase our profit, but it does not mean we already received the money. So we are correcting that profit. As we correct the profit, we are deducting what was added, but we did not receive it. It was added on accrual basis. Members, I hope we are getting it. The next element that we are going to look at the finance cost. Look at the finance cost or interest expense. You can call it finance cost or interest expense. Let me just write it in small letters, interest expense. They mean the same thing. So where do we get the interest expense? Let's all look at the income statement, and you will realize that finance cost was there, charged at 14 shillings. Charging the interest expense there does not mean it was already paid. You are not told that it was all paid. And how do we know that it was not all paid? It was not all paid because if you look at the balance sheet, you realize that there is still interest payable. You see that? There is still interest payable. So, because the interest paid is in another section of the cash flow statement, we will still come and ask ourselves, out of the total interest that was charged, how much of it was paid? And we will capture it here. So for now, we are correcting our profits in the income statement. So meaning we are going to add back the full interest that was charged. We are going to add back the full interest that was charged, and the interest expense or the finance cost was 14 million. We're going to add it back in full. Members, I hope we are together. I just hope we are together. Now, I want us to go back and look at this income statement and see the interest income. You see the interest income there? There is an interest income there. That interest income was recognized as an income, but it does not mean that interest income was already received. So we have to do the necessary adjustment to it. It was recognized on accrual basis. We have to do the necessary adjustment to that interest income. So we will come, and because it was added as an income, we will now adjust by deducting the interest what? The interest income. Remember, in the acronym that we gave, and the acronym was dial God's number for food, or you rest in peace. Was interest income among the elements of that acronym? Was interest income among the elements? I guess not. I guess not. Because the I in that dial is for impairment. Interest income was not there. But I want you to remember that if you look at your statement of profit or loss or income statement given, and you see interest income, remember that that interest income should always be adjusted accordingly. So I will bring interest income and do the adjustment. It was charged on accrual basis. So please remember to always have that at the back of your mind. Now, I just want to edit out this loss on disposal. I hope no one will get confused here. So this loss on disposal, because we've realized there is a gain, I don't want to introduce another row. I just want to use this and retype it as interest income. Just want to use it as interest income. And what am I going to do? Because it was recognized as an income, I'm correcting my profits by now deducting it back. Now deducting it. It was added. Now I'm deducting it. Because that was just a recognition of an income. There is no guarantee, or there was no confirmation we received the whole amount. We are tracing movement of money. So I will bring it as a negative. I will bring it as a negative, like that, as a negative, like that. Good. Now, I'm seeing a question here. A member was asking something. Please repeat on depreciation amount. All right. H is asking about depreciation. Now, H, what I said about depreciation is very simple. Depreciation is the reduction in value of tangible assets, fixed assets. We call them PPE. Now, this depreciation was charged as an expense in the income statement, as you normally do. You remember when we were preparing our income statements, preparing our published accounts, we were computing depreciation. Then the policy or the examiner would tell you where to classify that depreciation, whether to classify it under cost of sales, under admin expense, under distribution, you'll be told. So this depreciation is an expense. The same way we charge, amortization on intangible, depreciation is on tangible assets. It is normally charged as an expense, but it does not mean it was paid. No one pays for depreciation. It was just recognized as an expense, but it does not mean money was spent. So because of that, we are correcting our profits. How do we correct? We are adding back expenses that were charged, but no money was paid. That's why we are adding back depreciation. It was charged as an expense, but no money was paid. So we are adjusting our profit by adding it back. The same way you've done for amortization, because it is also the same as depreciation. It's just that it applies now to intangible assets. I hope the member was called who? I hope H has gotten it. I hope H, we are now together. Now let's move to another entry. We've captured all that. Let me see. Before we come to working capital elements, is there something we are missing up there? Is there something that we are leaving before we adjust for working capital? And by the way, I want to give you a very easy approach in doing the working capital elements. A very easy one. A very easy. All right, Juba is saying we've not left any element. So I just want to get the total. The total of these adjustments we've done here. And we normally call this cash flow from operating activities before adjusting for working capital. And again, by the way, in an exam room, you can either write that narration or you don't write it. No one will penalize you. And even if you write it, you will not score any extra marks. Remember that very well. So I will not write all those things. You can write, you can type it on your end. Cash flow from operating activities or cash flow before adjusting for working capital. This is the amount. Cash flow before adjusting for working capital. This is the amount. On my end, you'll excuse me, I'm not typing that because it is adding no value. But you need to know what it means. Cash flow before adjusting for working capital. All right, now, let us now do the working capital adjustments. If you get very neat members in an exam room, they will even give this one a title. They will say working capital adjustments. Very clean, very neat. But if you have all the time, please go and do the aesthetics. If you don't have time, please just do the entries and score your marks and go home. Yes, very good, very good. Why is gain on disposal negative? Thank you, Alan. Alan, you must have missed out on something. Now, Alan, listen. Gain on disposal of a PPE. How did we get the gain on disposal of a PPE? We compared the net book value of the PPE element disposed. Disposal means selling off. We compared the net book value of that PPE element that was sold off, the net book value, the value that was appearing in the books as at that time when it was being sold off or disposed. We compared that with the proceeds. Proceeds mean what you get when you sell it off. And we realized that the proceeds was higher than the net book value of that PPE element. So in any instance, when the proceeds or the amount you get when you sell is greater than the net book value of any element of PPE you've disposed, then what you've done is you've sold at a profit, at a gain or profit on disposal or on sale. There is a gain or profit on disposal when the proceeds on disposal is higher than the net book value or greater than the net book value. But whenever you realize that the proceeds or whatever you get when you sell is less compared to the net book value of an asset or an element of PPE, then what you've done is you've sold on a loss. You've sold on a loss on disposal. You've disposed but at a loss. Why? Because you've gotten an amount which is lower than the value of the asset. Now, in this case, because we've realized there was a gain on disposal, there was a gain. The proceeds was higher than the book value. Now, this gain must have been recognized. It was recognized as an income. Remember, we are not preparing published accounts. It has already been prepared for us. What we are doing is understanding and interpreting and following on the movement of money, cash flow from that prepared statement. So we are reasoning from the point of preparation. How do you prepare published accounts? You normally recognize gain on disposal. Now, it has already been done. So what do? We ask ourselves, in that gain on disposal, was money spent or did we receive any money? It is a gain, yes, from a bookkeeping entry because our statements are prepared on accrual basis, meaning we recognize income when we earn, but not when we receive money. Now, a gain on disposal means we've earned the money. But have we received? The answer is no. So as we correct our profit before tax with the adjustments that were done, that gain on disposal, it was added as an income because it was an amount which was higher than the cost or the value of that book of that PPE element. It was recognized as an income. Now, to correct our profits, we are now deducting it. It was added. Now we are deducting. For expenses, they were deducted. They were charged. Now what are we doing? We are adding them back. I just hope that Alan has gotten something. Okay, Muli is asking a question: if not given depreciation but provided with accumulated depreciation, what is the treatment? Okay, now Muli, I want you to, that's a very good one, but Muli, in this case, remember, if you are given accumulated depreciation, then that means the examiner wants you to compute. You are the one to now calculate your depreciation. Because accumulated depreciation is just the total cumulative depreciation on the asset during its lifetime of usage since it was purchased to date. The amount that it has always, it has reduced in value, put together in a lump sum. We call it accumulated depreciation. So in that case, you do not adjust accumulated depreciation. You adjust depreciation charge for the year. You adjust depreciation charge for the year. And I believe you know that for you to get the net book value, when asking yourself whether there was a gain or loss on disposal, you are comparing net book value. How do you get the net book value? You know net book value is normally the difference between the cost of the asset and that cost of the asset, you deduct the total depreciation to get the current or the closing net book value. And I've talked about total depreciation, meaning what? Meaning what? To get the net book value at the end of a current year and you have accumulated depreciation, you will also compute depreciation charge for the current year. You add to that accumulated to get the total depreciation. That's why I've used the word total depreciation. You deduct all that from cost to get net book value. I hope that makes sense. Language of the examiner will be very key at that point. All right, members, I want us to proceed. I hope I've cleared the questions that were being asked. All right, adjustments for working capital elements. I said I'm giving you a very simple way and approach to do that. I said I'm giving you a simple way, and the simple way is here. I want you to listen. Now, when adjusting for working capital, you remember that working capital elements are only two. Working capital elements are current assets and current liabilities. I hope we all know that, current liabilities. These are the only elements of working capital. And in most cases, we have receivables, inventory, and payable. These two are elements of current asset. Payables is an element of current liability. Now, it is very simple. What approach do we do? When dealing with the asset elements in the working capital, that is receivable and inventory, the approach is very simple. Take the opening balances. Take the opening balances, then you compare with the closing balances. So when I talk about opening balances, you have to take care of any adjustments to them, any adjustments that happen to them, then you compare that with the closing amount. And that applies to these two asset elements, receivables and inventory. We're going to see what are these adjustments. I'm going to show you what are those adjustments that we are talking about on the receivables or on inventory on inventory. In fact, inventory will explain the adjustments very well. Do you know why? Inventories, you can always buy more inventory elements. When you buy more inventory, that is an adjustment. When you sell some inventory elements, that is an adjustment. Receivables can also be adjusted. If there is an element of receivable that was not captured, that is an adjustment. So that one will depend on how the question is framed. But the logic is opening, compare with closing. You get your answer. When you come to the liability section of the working capital, and one of the elements that represent liability is the payables, you now do the opposite. Start with the closing. Then that closing, you compare with the opening. And of course, opening must have, if it has adjustments, you take care of those adjustments. Normally, adjustments starts from opening because that is what is starting a period. You adjust it, then now you get the closing. So you compare the opening plus any adjustment, and then you deduct it or compare it from closing. You compare it from closing. In this case, it was opening, you compare with closing. So I want us to do it, expressly in the cells so that you get to see what I'm talking about. Now, look at, I know there are these terms normally you talk about, was there an increase Was there an increase in receivables or a decrease in receivables? Was there an increase in inventory? You compare the periods. Yes, increase. Taking the root of increase is very good. But where you might get confused is, do you know whether it is an outflow or an inflow? If you don't have that reasoning, you might know that it is an increase, but you put a wrong sign here. You put it as a negative or a positive when it's supposed to be the opposite, and you will miss the marks. I don't want you to miss the marks. Master this approach, you will always get all this section right. Master the approach of, for the asset elements, for the current asset elements, take the opening, compare with closing, like that. Whether you get a positive or a negative, leave it like that. If you have the reasoning behind it, whether it's an increase or a decrease and what effect it has on cash flow, the better for you. But if you don't have it in an exam room, do not scratch your head so hard. Post them and move. Get the maximum score that you can get. Members, I hope that makes sense. Let's do it together. Receivables. I will put an equal sign and go and pick the opening balance. Where is receivables? Statement of financial position. Under what? Current assets. Receivables is here. Where is the opening? Opening is 240. Why am I calling it opening? Because it is the one under the column of 2022. All right? 2023 is the current year, meaning this is the closing. So I've just picked the opening. And what do? Is there any adjustment? Our additional information will advise. But before it advises us, I told you to harvest the low-hanging fruits. Just pick the opening, compare it with the closing, like that, and do not worry. If there will be adjustments, you will adjust. If it is not there, you will leave it like that and you score your marks. I will just hit enter and I'm having a figure there of negative 24. You see that figure? That figure means it is an outflow because it is negative. But if you want to look at the reasoning behind it, you will come and ask yourself, you'll ask yourself here and say that now, this is receivables. If it was 240 in 2022, and it has now gone up to 264 in 2023, this is receivables. Is it an inflow or an outflow? Are you looking at what I'm talking about? You will start asking yourself a lot of questions which you might not have time to do in an exam room to know whether it's an inflow or an outflow. An increase in receivable is an outflow. Why? Why is it an outflow? Receivables arises from credit sales. Yes? When you sell more on credit, in essence, it is an outflow. That's why receivables have increased from 240 to 264. You've sold more on credit. You've sold more on credit. That's why it has increased. So in other words, it is an outflow. That's why when we use this my simple approach here, the figure is coming as a negative. So this approach here do not require your argument. It only requires the entry and you score the mark. I hope members we are getting it. Let's do for inventory once more so that we see, because they are both elements of assets. For inventory, you also approach it the same way. You go and pick the opening inventory. Where do you get it? Current assets. Current assets. There it is. I will just pick the opening. Opening is under 2022. And what I do is to just compare it with the closing in 2023. I don't have to mind about the reasoning behind it. I just hit enter and I have my figure of 50. You'll ask yourself, what is that 50 about? What is that 50 about? You see it is positive, meaning it is an inflow. I will leave it at that if I don't have time to reason. But if I have time to reason, I will go to my statement of financial position and look at the inventory movement and say, if in 2022, the inventory closing value was 330, but then inventory has now reduced from 330 to 280. It has reduced by 50. What has happened? Inventory only reduces when you sell. Inventory reduces when you sell. And what happens to money when you sell? What happens to cash flow? When you sell, you get money. So reduction in inventory means an inflow. You sell, you get money, and money now is an inflow. Remember, we are doing a cash flow statement. That's why you will see the 50 is coming in as a positive. Using this approach, you don't have to look at that reasoning. The figure you get will be correct. Whether you understand whether it's an inflow or an outflow, it will still be correct. You leave it there. You score your mark and you go home. If you want the reasoning, that is how you reason. Reduction in inventory means you sold. An increase in inventory means you purchased more inventory elements. When you purchase more inventory elements, it means money is going out. You are spending money to buy. That will be an outflow. I hope that makes sense, members. Now, the same logic we apply in the payables. And I told you now payables is the opposite of receivables, of the asset elements, the ones that we've done above, the receivable and inventory. So what do? We come here and the payables that we have, pick the closing first. Let's go to the balance sheet. And I hope you are seeing payables. You see that? Trade payables. We are now starting from the closing. Which one is, where do we pick the closing? 2023 column, the closing. And what do we do with it? If there will be an adjustment to it, which the additional information should tell us. But before it tells us whether there is an adjustment or not, let's just pick it and compare with the opening like that. And then I will just hit Control Enter. And I'm having my answer there as an impact on the cash flow. And you can see it is positive 170. Now, if you want the reasoning, if you have the time, you can still reason out. Yes? Now, you know what payables are. You know what payables are. These are people you owe, right? So let's come to that payables line and reason now. We've already gotten the answer, but we want the understanding of it. Now, for payables, you see, it started in 2022. It closed 2022 at 254, the payables. Now, it is at 424. It is now at 424. Payables has gone up. Payables has gone up. And it has gone up by how much? By the 170. It has gone up by the 170. So how do payables arise? How do the liabilities arise? Payables arise when you do what? When you buy on credit. You buy and you don't pay on credit. And whenever you buy on credit, if you look at the movement here between 254, it means in 2022, you only had a balance of 254 at the end of it. But at the end of the current year, you've bought more on credit. You are owing more to your creditors. That's why it is a liability. Now, what happens to that in that case is when you buy more on credit, then it means, when you buy more on credit, then it means it is in essence an inflow. It is in essence an inflow. That's why in our cash flow statement, using that my direct approach, you get 170 as a positive. That means it is an inflow. It is an inflow. So if you don't want the headache of reasoning behind it, just employ this approach and whatever you get will still be correct. Now, members, after looking at the working capital elements, we go to these two notorious fellows, tax and interest. And I also want to give you a very simple approach on the same. Very simple. You don't have to scratch your head so hard. You don't have to scratch your head so hard in that area. Why am I saying so? The approach that we've done under working capital elements, and by the way, I'm not putting in the subtitles, but you need to have them if you have the time. If you don't have the time, get the overall effect and move. What am I talking about? I told you this amount of 312 was the cash flows before adjusting for working capital, right? Now, we have adjusted working capital. The amount that you get here is the cash flow after adjusting for working capital, and we can get that amount. What is the amount? We start from the 312, we get the effect of the adjustments. That figure that you get, in this case, it is 508. This figure is the cash flow after adjusting for working capital. Cash flow after adjusting for working capital. Sometimes you can call it cash from operations. Yes. In fact, that is a very easy. You can call it cash from operations. That is the cash flow after adjusting for working capital. You can call it cash from operations like that. Then, now we adjust these two elements to get the total net cash, which was received from operating activities. Yes, net cash from operating activities. So, interest and tax paid is also very simple. I want you to approach it the same way. And how do you approach it? You see tax paid and interest paid. I want you to think of them as liabilities. Think of these two elements as liabilities. Meaning what? You will handle them the same way we've handled this element of current liability when adjusting for working capital. You will compare the closing balance with the opening plus adjustments. So if there will be no adjustments on the opening, or adjustments simply mean what happened during the year. Those are the adjustments I'm talking about. Like now, when you talk about tax, when I pick the closing and I compare with the opening, I will adjust the opening. How do I adjust the opening? I will ask myself, during the year, was there any tax that was charged? That is the adjustment I'm talking about, and we are going to see it. So look at these two elements as liabilities and adjust them accordingly. Straight away, let's go and do that in this cell. And I want you to see that approach. It will help in an exam room, so that to know whether what amount was paid. If it was paid, remember, we've said tax paid. We've added the word paid. Paid. Also interest, we've added the word what? Paid. Meaning what? You expect your answers to be outflows. You expect your answers to be negative. Members, I hope you are getting it. These are paid. When you pay, you spend money. Money spent is an outflow. So let's check if that will be confirmed true. Now, look at the income statement or the statement of profit or loss. You see this amount of tax. Where was tax? I want to look at the income tax expense. Where is it? Yes, this one. You see the tax that was charged. The income tax expense for the year was 64. Now, look at the balance sheet and see how much tax was outstanding at the end of the year. Current liabilities. How much tax? You see current tax was outstanding how much? 58. Do you see that? 58. But do not only look at the end of this year only, 2023. You must also consider what was there in the previous period. Remember, in 2022, the current tax had a liability of 40. You see that? And then in the current year, it has a liability of what? 58. You have to consider those two. And you also merge that with the charge for the year and ask yourself, was tax paid? So let's go to that cell and do that adjustment. So I will put an equal sign. I told you to think of them as liabilities. We start with the closing. Which closing? The year 2023. What are we closing? We are closing the liability. So we go to the balance sheet. We go to the balance sheet and pick the closing balance. You see the closing balance here for tax? The closing balance is 58. That is where we start from. And we compare or subtract the opening plus adjustments. That's why I'm putting a bracket. Why am I putting a bracket? To take care of the adjustments on the opening. Remember, we are not adjusting the closing. We are only adjusting the opening. So closing minus, I've opened a bracket. And after I've opened that bracket, yes, after I've opened that bracket, I will go and pick the opening balance. Where is the opening balance? The opening balance is this one, the one in 2020, 2022, like that. Then I will ask us, during the year, was there anything that affected the tax account? The answer is yes. During the year, we must have charged income tax expense. Where is it charged? In the income statement. Let's go together and check it out. You see there was an income tax expense. This happened during the current year. We've picked the closing. We are comparing it with the opening, and we take care of adjustments. Now, what effect did the current year's income tax charge have on the opening? Did it increase the opening or it reduced the opening? Somebody tell us. Did the income tax charge for the year increase the opening or reduced the opening? And when I talk about opening, I'm talking about liability, opening liability and closing liability. So on opening liability, did the current year's tax increase it or reduced it? So that we do the adjustment accordingly here. Very good, increased. Thank you, members, thank you. It increased that liability. So what do? We add the income tax expense for the year. We are adding the amount what? 64. But because 64 is given as a negative and I wanted to refer to this cell, I will put a negative there to cancel out that. Members, I hope you're understanding why I'm putting a negative. But we are adding. I know somebody will get confused. Let me just do the necessary. It increases the liability by 64. So I'm typing it in so that I don't put in that sign to cancel out this. Somebody will ask, you said it increases, but why are you deducting? I was just deducting because of the sign of negative, but you can as well just add it like that. Yes, members, we have adjusted the opening balance on that tax account. Now, what other thing affects the tax account? What's the other thing that affects the tax account, members? Is there something else that affects the tax account?
A question, Mwalimu.
Yes, go ahead.
In case the tax liability reduces, so such kind of cases, do we subtract or?
The tax liability reduces. No, what happens is, you remember, we picked the closing. You just pick the closing the way it is, the closing for the current year. Yeah? You know, in this case,
Yes.
we are still looking at the simple approach. Then we will come to explanation. When we come to explanation part, you're going to understand it. Are we together?
I'm asking,
Yes.
asking.
Yes.
Assume the tax in the income statement was let me say 30.
Okay.
Yes. How will we treat it now? Assume it was 30, not 64.
No, regardless of the figure in the income statement, that is the current year's tax charge. And whatever is charged for the current year increases the tax account, the tax liability account. Are we together?
Okay, thank you.
Yes, so we're just adding whatever is charged in the income statement the way it is. We are not looking at that amount. Whatever is charged is the current year's liability for tax, meaning it should be paid. Remember, that amount should be paid. So we are just asking ourselves, out of what was charged and out of the previous year's liability that was carried forward, how much have we paid? That's why we are comparing the closing plus the opening and the adjustment for the year. I hope it makes sense. Does it make sense, Collins?
Yes, it makes sense.
All right,
makes a lot of sense.
Very good. So after that, is there any adjustment for tax? Was there any tax liability that was not charged? And where do we get that information? If we were told anything to do with the tax in the additional information here, then we will adjust it accordingly. But because we already read them, I don't remember seeing anything that was not captured in tax. Because tax was already given, tax charge for the year, and I don't think there is anything that is remaining. So in that case, I just close my bracket and hit on enter. And whatever I'm getting, I'm seeing there, I'm having what? I'm having 46, and it is coming as a negative. Meaning what? It is actually tax paid. Actually, it is tax paid. Now, let's look at the reasoning part of it. Now, how do you look at the reasoning part of it? I will ask you, if you have a liability, meaning you have an obligation, you have a tax that you have to pay to KRA. And how much is it? For the last year, 2024, for last year, 2024, you had a tax liability of 40. You are supposed to pay 40 million, but you did not pay. For that year, you didn't have the money to pay it. Meaning, this year, 2025, you've started with a liability of 40. Your opening liability is 40 for tax. You owe these people this money. You need to pay them. Now, at the end of this current year, at the end of this 2025, you've also charged during this year, you've also charged tax. You've also charged tax of how much? 64. Out of your trading profits, KRA wants you to pay them 64 million. Remember, last year they wanted you to pay a some amount, but there was 40 that you did not pay. Maybe you paid part of it, but 40 was a liability that remained close to the year. Meaning they want you to pay the 40 plus what they want you to pay for this current year. So at the end of this year, the Kenya Revenue Authority wants you to pay a total of how much? 104 million. I hope members we are together. And you realize that at the end of this year, your liability or the amount that they want you to pay now is 58 million. You brought forward a liability from the previous year, and you've added the liability for the current year. You had 40 you are to pay. In this year, you are supposed to pay 64. But at the end of the year, you realize they only want you to pay 58. You must have paid part of the money. What brought about the reduction? The tax liability reduced from 104 to 58. That liability can only reduce when you pay. So you ask yourself, how much of this tax did I pay? So you get the difference between the total I was expected to pay to the outstanding I have at the end of the current year. And you'll realize that you paid a total of 46 million. That is the reasoning behind that. And in my approach, you don't have to go to that route of reasoning too hard. You just have to take the closing. compare or subtract the opening plus adjustment. Adjustment in this case is the current year's income tax charge, income tax expense for the current year. Members, I just want to believe and hope that we are getting something. Are we getting something, members? Confirm if you are getting something.
Mwalimu, kindly repeat for me how we got this 46. I kind of got lost.
Okay, Winnie, I'm just checking on the rest. I'm seeing the rest. We are together with all the rest. So except Winnie. Okay, Winnie and Liaka did not get it. All right. Winnie and Liaka, I want you to listen again very briefly. Now, what I've just done, I've given you two approaches. My first approach was to tell you, I told you to treat tax and interest expense, tax paid and interest paid, I told you to treat them as liabilities. When you treat them as liabilities, we are borrowing onto the concept that we used above when adjusting for working capital elements. And that is the approach of, we pick the closing amount. Where do we get the closing? We get the closing amount from the balance sheet. The closing is what is at the end of the current year, 2023. This is the figure that we picked as a closing. Then we compare. Comparing means we are deducting with the opening balance of the current tax liability. Remember, we're in the liability section of the balance sheet. We picked the closing liability. What are we expected to pay at the end of the current year? That is a closing liability. Then we go and compare it with the opening liability, meaning what were we required to pay from the start of the current year? And then what adjustments happened to that opening is the income tax charge for the year. So I added 64. Where did I get 64 from? 64 is the income tax charge for the year. It is in the statement of profit or loss. You see the 64. It was an expense, meaning this was the income tax required to be paid for the year, given the sales for that year, the income that was realized. So opening plus the 64 current year's income tax charge, compare with the closing. That's how I got it. That was one approach. The second approach is about reasoning, and this is where I want you to now understand. If you understand the reasoning, this my first approach becomes very easy. What is the reasoning behind it? I gave an example. Wherever you work, if you're working, Winnie and the other member, I've forgotten the name. Last year, 2024, I'm using last year so that you can relate. Last year, 2024, you closed the year with a debt to KRA, with an obligation, with a liability, tax liability of 40 million. 40 million was the liability closing 2024. If it closed 2024, meaning it has opened 2025. I hope you get that. And in the current year, 2025, from your sales, you have to pay tax on your profit, and the tax you're supposed to pay is totaling to 64 million. You see this income tax expense, I'm assuming it is an income tax expense for the current year, 2025. You're supposed to pay 64 million. You owed them 40 when you started the year. You've added another liability of 64 in the current year. So how much total do KRA expect you to pay? They expect you to pay 40, which was from the previous period, plus the current year's charge of the income tax of 64. So they expect you to pay them 104 million. I hope we are getting it. So your total liability for the current year is 104 million. Now, when you went to KRA, assuming you didn't know whatever happened behind the curtains, and you went to KRA you go to KRA at the end of the year, and you realize that the amount that they expect you to pay, the closing liability they expect you to pay, is not 104. They are telling you that you are supposed to pay 58 million. Where do I get 58 million? It is this one here. The liability closing the current year. They're telling you that your liability closing this current year is 58 million. What must have happened? You knew you were supposed to pay them 104. That was the total liability for the year. But now you only owe them 58. What has happened? You must have paid some of the money. Some of the money must have been paid. So the question is, how much was paid? It is the total liability, the opening liability plus the current year's charge, the 104, minus what they expected to pay, the outstanding liability at the end of this year, which is 58. That difference is what was paid. You must have paid the difference so that they only want you to pay the 58. The difference is how much? The difference is now 46. This is what was paid for the tax. So that the liability has reduced from 104 to 58. So that's why we are treating 46 as an outflow, because this was tax paid during the year. Does it make sense, Winnie and the other member? Does it make sense? All right, very good, very good. Yeah, good. Once you've understood that concept, I tell you members, there is no question of cash flow that you will get and get stuck, because that concept will remain. That concept is not going to change. And that is always what I insist on. Just get the concept. You don't have to revise 100 cash flow questions. No. Once you know how to compute tax paid and interest paid, you are home and dry. Just stick with the concept, know the adjustments, and go home. Yes. Now, iPhone is asking something very nice for deferred tax. Now, iPhone, let us all go to our balance sheet and check our non-current liabilities. Do we have deferred tax? In our non-current liabilities, we do not have deferred tax. But what if we had deferred tax element as one of the non-current liability here? What could have been the difference in treatment? Remember, deferred tax is still a tax element. Deferred tax is still a tax element. Using my approach of getting all in one cell, this approach here, you see, if you have deferred tax, then it tells you if there was a deferred tax line in our balance sheet here. Let me just assume there is a deferred tax element. I will remove that row. I'm just adding it there. Assume there was deferred tax. And this deferred tax line, it must have opening and closing, right? You will be given an amount of deferred tax for 2022. Assume it is 10 for 2022. Then at the end of the current year, assume you are given deferred tax as 30. Yes? Now, what is the difference in the computation of the tax paid? What impact will the deferred tax have in the computation? This is very simple. If you employ the approach that I gave, or if you employ the reasoning part of it, I can even start from the reasoning. You opened the year with a liability. You opened the year with the current tax liability. Now you have to be specific for current and deferred. What is deferred tax? Deferred tax is a tax that has been postponed. Let's take it as basic as that. Deferred tax is tax that has been postponed. It was deferred from the previous period to be paid in future. So this deferred tax means in 2022, there was tax that was accumulated from the previous periods. Current tax is the tax for the current year. So in 2022, you had a liability at the end of 2022, you had some accumulated tax from the previous period of 10 million. From the previous periods, it was accumulated, it was postponed. It has been postponed over the years, and it totals to 10 million at the end of the year 2022. I hope we are getting it. Then, at the end of the same year, 2022, the tax that was charged for that year, you also did not pay it in full. The current tax for that year, you also did not pay in full. I hope you understand the two different things. Deferred tax was postponement from previous periods. Current tax is the tax for that particular year. So for the year 2022, you did not pay the tax for that year in full. Meaning you had some liability for that year for the current tax of how much? 40 million you did not pay. So meaning at the end of 2022, you had a total tax liability of 50 million at the end of 2022. So if you had a total of 50 million at the end of 2022, then when you started 2023, you also added some other liability. Which liability? You added tax for the year. Remember, you're starting a new year. So the tax for the year is now 64 million, the one in the income statement. This was the charge now for 2023. Total liability that opened the period is 50, meaning at the end of the year 2023, you will be required to pay a total tax of 50 plus 64, meaning they want you to pay 114 million. Now you ask yourself, at the end of now the current year, you also have still liabilities to pay. And you realize that at the end of the current year, tax that was postponed from previous periods is totaling to how much? Is totaling to this 30, which I've given here. Then for the current year, the tax that was been charged on your profits for this year, yes, for this year, you have an outstanding of how much? You have an outstanding of the 58, this 58 here. So if that is the case, you realize that the closing liability for the current year is how much? 88. If the closing liability, you expected it to be 114 because the accumulated from the postponement, the deferred tax for the previous period, plus the current tax that you did not pay at the end of that last year, 10 plus 40. That is the total that opened the current year. Then in the current year, you had a tax expense of 64. Closing liability, you expected to be 114. You expected to pay 114. But at the end of 2023, the liability outstanding is 30, which is the deferred, plus this 58, which is the current. The total that they expect you to pay at the end of the year is 88. So there is a reduction in the liability. A reduction in liability means you must have paid part of the liability. How much did you pay? If you were to pay 114, but now your liability is at 88, you must have paid how much? 26 million. So this now becomes the tax paid. That is the treatment of deferred tax. Members, I hope you are getting it. And because it's already past 7, we cannot proceed past that time. Let's finish the remaining part tomorrow. Thank you and have a good day. Bye.
Thank you. Bye.
All right.
Thank you.
You're welcome. Bye, members. Bye.